Well, markets have been extremely strong with Trump backpedaling on his trade war. But is this a return to the highs, or have markets become too complacent? So hi there everyone, welcome to the Traders Circle Weekly Market Update. Today is Tuesday the 29th of April 2025, and before I get started, you do need to be aware that whatever I say is general advice only. So Trump is backtracking as quickly as he can from his trade war. Already he's quote-unquote delayed the reciprocal tariffs against everyone but China. And at the moment he's basically saying that they're going to do a deal with China. In fact, he's practically begging China for a deal. And so far China has been quite reluctant to say they're even negotiating at all. Yeah, absolute crickets from China where Trump is saying that they're speaking every day and they're working on a deal and that it's going to be close. So basically Trump's backtracked because of the response from the market, because it's become pretty clear that, it looks like the economy could head towards recession if the deal isn't made. And basically because the US has no cards. They're playing poker without any cards. Trump's very much beholden to his approval rating, to the polls, and China obviously doesn't have that at all. So he's basically up against a wall, and if a deal is made, no doubt markets will rise, but it'll probably be on quite bad terms for the US. Back to those reciprocal tariffs, it was stated that they would be delayed for 90 days, for 3 months. I think the reality is that they're not going to be brought in at all. I think that we'll quietly not hear about the reciprocal tariffs. Everyone's been brought back to the 10% rate, and even then, plenty of exemptions, plenty of things excluded. And, to be honest, the tariffs haven't actually been being drawn at all for a lot of countries due to some administration issues. I think the market has been quite enthused that Trump's backpedaling. I think basically they've taken a view that he's going to keep backpedaling and that there won't really be any tariffs implemented. So it begs the question, why was all this done in the first place? There's no good answer for that. I think it was ham-fisted, nothing gained but an awful lot lost. And with the tariff settings as they currently are, without a deal made with China, we probably will see the US market or the US economy head towards recession. So the longer that it takes for a deal to be made, the worse the outcomes will be. And I do think markets have become too complacent in assuming that Trump will be able to get a deal done. Like I said, if no deal is done, things will turn out pretty bad. And we haven't seen the effects of no deal as of yet. Keep in mind it takes a while for stuff to be shipped over. I'm sure plenty of activity was pushed forward before the tariffs. And so when we start to see what activity looks like with the tariffs in place, I don't think it's going to look pretty. All right, but turning a bit more towards the Australian market, and I think the Australian market is a little bit enthused by likely tomorrow's inflation reading, which is expected to come right down. Trimmed mean CPI is expected to come in at about 2.8% for the quarter, and that's inside the RBA's target range, down from 3.2%. That should herald the expected RBA rate cut in mid-May. RBA is expected to do another 25 basis point cut, possibly even more. Regardless of the inflation reading tomorrow, I think that'll happen. Unless obviously it's a very strong inflation reading. But even if it's a little bit stronger than expected, we still probably will see that RBA rate cut. And then the market's expecting another 3 or 4 rate cuts after that this year. That's been a bit of a bullish driver for our market, but it doesn't tell the full picture. And the full picture is that basically, economic growth is expected to slow, unemployment is expected to rise, and corporate profits, which for the Australian share market have fallen for 3 years straight, are really going to struggle to rise with those conditions. So, I think again our market perhaps looking a bit complacent with valuations at all-time highs. And yet, 3 years of declining earnings with a weakening economy and with rising unemployment. But that's the world we live in, and it certainly looks like the momentum is to the upside. Part of that could be due to the sugar hit of the expected drop in inflation and the expected lift in interest rate, cut of interest rates. Finally, we've got reporting. Currently, we're in the middle of a US earnings reporting season. Keep in mind, this season is for a period prior to the tariffs being implemented, or at least the vast majority of them being implemented. And it's not going particularly great. The number of beats is running below average, and plenty of companies downgrading forward guidance or removing guidance completely due to the tariffs. The big events this week, though, will be the tech reports. So we've got Facebook and I believe Google on Wednesday night, Facebook and Microsoft on Wednesday night, and then Amazon and Google on, Amazon and Apple on Thursday night. Regardless, there's 4 of the big ones reporting on Wednesday and Thursday night, and that will definitely move US markets, and it'll probably, as a result, move the Australian market. But perhaps more importantly for the Australian market is the bank reporting period, which comes up starts in the first week of May, or the second week of May, I should say, looking at my own graph. So we've got Westpac on the 5th, NAB on the 7th, ANZ on the 8th, and Macquarie on the 9th. And then CBA is going to give a quarterly trading update on the 14th. Now, the banks all fell off very strongly in February, and that's basically because their share prices were extremely high. And once again, the results were pretty poor. Bank earnings have declined for the last few years, other than CBA, which has basically held fairly steady. Yet despite that, share prices have gone up extremely strongly. In some cases 40 to 50%. So the share price rise without an equivalent rise in earnings is a bit odd, and it has taken the Australian banks to the most expensive banks on earth. So the question will be whether these results can justify those share prices. If they can justify those share prices, I think we will see a fair jump to the upside from these banks, and then they'll go to a ridiculous valuation again. If they can't, though, there's a lot of room to the downside for these banks. Now, the constant argument is that they're protected. They're always going to make money, Australian housing market's extremely safe, yada, 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 yada. What I would say is that anomalous valuations have occurred constantly throughout history, and every time that they've occurred, people have said, well, this time is different and this time it's justified. And every time without fail, those anomalous valuations have come back to normal. It's occurred at every point throughout history. It's occurred on our banks in the past. So I would just say, big caveat there, there's no guarantee that, this anomaly will last forever. So let's have a quick look at the charts for this week, guys. And this is the Australian XJO index. Currently, as you can see, we've jumped quite strongly off our lows from early April. We bottomed out around 7250, maybe 7200, and then we've actually rebounded about 12% since the April lows. It does take us back to basically where we were before the tariff selling. Now, whether that's justified or not, I'm not so certain. And again, whether that's justified given how the banks reported in February, I'm not so certain. But it does leave us in an interesting technical position. We've broken above the key 8,000 level and the 50-day moving average. And we're now looking around sort of 8150, which is also where the 200-day moving average sits. 8150 was a bit of a support level last year, and it may act as resistance to the upside on the current move. Regardless, even if it does, that will be a higher peak than our late March peak. And so that means we could look at a wedge pattern, or this could be the start of an overall uptrend. It's not quite as positive for the US market. So if we have a look at the S&P 500 chart, and we can see that here. They bottomed out just below 5,000 in early April, and they've returned to their support level from March. And that's roughly 5,500, maybe a little bit above on the S&P 500. They have broken their downtrend line, but it's not a clear break back above that sort of previous support. That level may now be acting as resistance. So if that level does break, we would expect a move back towards roughly 5775, 5800, and that's their late March peak. That's the equivalent to our sort of 8,000 point level. So it is a bit odd that we've gone so hard when they haven't even returned to that peak there. That does coincide with their 200-day moving average, And that's sort of another suggestion that they could head to that level if they can break above this sort of 55.20 level. So their technicals aren't looking quite as positive as ours, and they haven't, regained as much of their losses as we have. We can see that by the fact that they're still below their 50-day moving average, still below their 200-day moving average. Now, part of their underperformance is their inflation outlook is a bit stronger than ours with the tariffs going on. That means that they're probably going to see fewer interest rate cuts from their Federal Reserve, as we will from our RBA. And then there's also the more direct effects of tariffs on the US economy. So all of that probably working against their market. Still though, they've had an impressive bounce back, and the technicals no longer look as bearish as they did as little as a few weeks ago. So we'll wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you guys next time.